everyone, and welcome back to the MCF Participant Education Series. I'm Hunter Nighbert, Financial Advisor and Retirement Planning Specialist with MCF Advisors. And today we're diving into what might be the most deceptively simple financial question you'll ever face. Should I pay taxes now or later? That sounds easy, right? But when it comes to your 401k contributions, choosing between Roth and pre-tax is like choosing between an apple and an orange. They both look good, they both have benefits, and depending on your taste, or in this case, your tax bracket now and later, one might suit you better. So today we're going to unpack what each contribution type actually means and who benefits from each strategy. Whether you're early in your career or hitting your peak earning years or somewhere in between, understanding this choice now can save you significantly later and give you more control of your retirement income. So here's the million-dollar question. Do you want to pay taxes now or do you want to pay them later? That's essentially what you're choosing when you're choosing between a Roth versus pre-tax 401k. With pre-tax contributions, you reduce your taxable income today. You're deferring taxes until you withdraw the money in retirement. With Roth contributions, you pay taxes now, and you get to withdraw everything, contributions and earnings, completely tax-free in retirement. And that's a pretty powerful incentive. So let's break it down and make this decision work for you. Let's take a closer look at pre-tax contributions. When you choose this option, the money you contribute reduces your taxable income today, which means you'll pay less in taxes this year. Now that's especially attractive if you're in a high tax bracket. You get an immediate benefit that you can see on your paycheck. The trade-off, all withdrawals, including any investment gains, will be taxed as ordinary income when you take them out in retirement. So who does it benefit? This is a solid choice if you believe you'll be in a lower tax bracket in retirement than you are now. If you're in one of the higher federal tax brackets, let's say 32% or above, the upfront tax deduction can offer significant savings. You're reducing your taxable income now when it matters the most. If you're in your late 40s or 50s and hitting your highest earning years, pre-tax may allow you to minimize your current tax liability while stacking up retirement savings efficiently. Those looking to lower their AGI for other purposes, pre-tax contributions reduce your adjusted gross income, which can help with things like qualifying for child tax credit, student aid, or minimizing Medicare surcharges. These can minimize your current tax liability while also stacking up retirement savings. Now, an interesting stat. Despite powerful long-term benefits of Roth, only 23 of participants use it. This means 77% are still going with pre-tax. Why? Well, for many, it's the immediate tax deduction. But behavioral inertia is real. People tend to go with what is the default or what's familiar. And the good news is you don't have to. You're here, you're engaged, and you're clearly interested in making smart decisions. So let's keep that momentum going. Now, let's talk about Roth. You're paying taxes today, which stings a little, but your future you may love you for it. Withdrawals are tax-free, which provide clarity and flexibility in retirement. It's also great for younger earners, those in their 20s and 30s or even early 40s, because you're likely in a lower bracket now than when you will be down the road. Bonus, no required minimum distributions from Roth 401ks started in 2024 if you roll it to a Roth IRA upon retirement, and that's a big win for tax-free compounding. Now let's look at really who wins with Roth contributions. So younger employees, as we mentioned before, if you're in your 20s and early 30s, your income tax rate are likely lower now than they will be on down the road. So Roth contributions let you lock in those low tax rates and grow that tax-free bucket over decades. Very powerful. People expect higher future tax rates. This includes younger workers on the rising income path, but also professionals who anticipate future tax laws changes that could raise rates across the board. It's also for people who want flexibility in retirement. Having a Roth bucket allows you to control your taxable income in retirement. This can help you reduce your tax hit on Social Security, avoid Medicare premium surcharges, or stay under key income thresholds. Also, legacy-minded investors. Roth IRAs are not subject to the required minimum distributions if rolled out of the 401k, and the heirs also receive tax-free income. That makes Roth an excellent estate planning vehicle. Now, you don't want to commit to just one. You don't have to. Most plans, including yours, allow you to split contributions between pre-tax and Roth. That's called tax diversification. It gives you more options and control over your withdrawals in retirement. Think of it as building two buckets, one taxable and one tax-free. In retirement, you can pull from whichever bucket makes the most sense based on your income tax and situation for that particular year. So when does it make sense to stop Roth contributions? This is a great question and not always talked about. If your income increases significantly and you enter a much higher tax bracket, it may make sense to switch from Roth to pre-tax. Why? Well, you might want the tax deduction now. Also, if you're nearing retirement and think your income will drop, you might defer taxes today and pay it at a lower rate later. This is a dynamic decision, not a one and done. We encourage reviewing it annually or when you have big life changes like a new job, get a raise, marriage, kids, or even relocation. So what is the right choice? Well, Roth is great if you're younger and in a lower tax bracket or want tax-free income later. Pre-tax might be better if you're in a higher tax bracket now or need an immediate deduction. And a blend could offer the best of both worlds. Your financial situation is as unique as your fingerprint. The key is to plan proactively and adapt as you go. Pre-tax versus Roth isn't just about taxes as we've seen today, but it is an important part of the equation. The thing to remember is don't get paralysis by analysis when choosing. If you're young, start with Roth. If your income significantly increases, split defer, and when you get to your peak earning years, go with pre-tax contributions. If you have more specific questions about what contribution is best for you in your personal situation, reach out to your designated plan advisor and schedule a one-on-one meeting. If you found this video helpful, I would encourage you to share it with your coworkers, family, and friends. Next quarter, we will cover market volatility and coping with fluctuations in your portfolio. Thanks for watching today. We'll see you next time.